Hello students, welcome to the lecture on accounting process, recording of transaction. After this lecture, you will be able to learn the following objectives. Explain the accounting process. Define the accounting equation. Classify the accounts as personal and impersonal accounts. Discuss the concept of double entry bookkeeping system. Explain the concept of debit and credit. Describe the concept of journal entry. Explain the ledger books. Describe subsidiary books and their types. Now let us know more about accounting process.
How we do this and how it's been done since the beginning is we have something called the accounting cycle or the bookkeeping cycle. And that cycle says, first off, we need to recognize the transaction and write it down. That's the Dear Diary, the following things happened to me today. Now, traditionally, we have done that by making journal entries. Journal entries says that instead of having a noun and a verb to make up a sentence or a complete thought, we will have a debit and a credit to make up a complete thought or to express the give-get of the transaction. Slice it and dice it into ledgers. And ledgers basically says we have accounts. And those accounts show all the information or all the give-gets that have to do with that account. Here in this class, we will use something called a T account. And so it might say cash. And we will take all this information from our journals and we will take all those cash give-gets and we will copy it into the T account or the ledger account for cash. Now, we said debits equal credits. A debit always is on the left side, and I abbreviate debit DR, and credit is on the right side. So we'll take all of those debits to cash, copy them to the left side of the T account. We'll take all those credits to cash and copy them on the right side of the cash account so we can kind of see what is our running balance in cash. It's kind of like your checkbook register. It's like this ledger account. So it's everything that happened to cash. Now, because we're copying data from one source, journals, to another source, ledgers, we have to make sure we copied correctly. So what we do is the third step in the bookkeeping cycle or the accounting cycle, which says we're preparing a trial balance. Now what the trial balance does is it takes the balances, in other words the net difference between the debits and the credits by account, and it makes a report. And that report has a column for all the debit balances, it has a column for all the credit balances, and it lists the accounts. So, for example, I would list cash, and cash might have a debit balance, so I'd put it here. I would total up the trial balance to prove that even after copying, my debits still equal my credits. And that's the first 3 steps of the accounting or bookkeeping.
Accounting process is very important for an organization as it helps to maintain the systematic records of all the financial transactions and avoid any possible errors. The accounting process is designed to determine the economic impact of the transaction on the business. The overall accounting process comprises the process of identification, measurement, and communication of the financial information of the organization to the interested users. Accounting process comprises 4 interconnected phases. The first phase is of recording the transactions, which is known as journalizing. The second phase is the ledger posting, in which all the accounts are classified and the balance of each account is determined. In the third phase, the trial balance is prepared, in which all the ledger accounts are arranged and aggregated into debit and credit balances which need to be equal. The trial balance helps in checking the arithmetic accuracy of the recorded accounts. In the final or the fourth phase, financial statements are prepared at the end of the accounting period, which involve the profit and loss account and the balance sheet. Accounting process. The financial accounting process consists of categorizing past transactions and events, measuring selected attributes of those transactions and events, and recording and summarizing those measurements. The first step places transactions and events into categories that reflect their type or nature. Some of the categories used in financial accounting include purchases of inventory, merchandise acquired for resale, sales of inventory, wage payments to workers. The next step assigns values to the transactions and events. The attribute measured is the fair value of the transaction on the exchange date. This is usually indicated by the amount of cash that changes hands. The initial valuation is not subsequently changed. This original measurement is called historical cost. The final step in the process is to record and meaningfully summarize these measurements. Summarizing is necessary because otherwise decision makers would be overwhelmed with an extremely large array of information. Financial accounting cycle. The financial accounting cycle is the process of recording business transactions and processing accounting data to generate useful financial information. That is, financial statements including income statement, balance sheet, cash flow statement, and statement of shareholders' equity. The time period principle requires that a business should prepare its financial statements after a specified period of time, say a year, a quarter, or a monthly basis. Major steps in accounting cycle are analyzing and recording transactions via journal entries, posting transactions to ledger accounts, preparing unadjusted trial balance, preparing adjusting entries at the end of the period, preparing adjusted trial balance, preparing financial statements, closing temporary accounts via closing entries, preparing post-closing trial balance, accounting equation and transaction analysis. The recording of business transaction in books of accounts is based on a fundamental equation called accounting equation. Whatever business possesses in the form of assets is financed by proprietor or by outsiders. This equation expresses the equality of assets on one side and the claims of outsiders, liabilities, and owners or proprietors on the other side. Every business concern generally borrows money from outsiders in order to carry on its activities. In other words, every business concern owes money to outsiders. These assets are financed by the funds supplied by proprietors and outsiders. Money borrowed from outsiders is called as liability. Effect of transactions on accounting equations. The assets, liabilities, and capital are the three basic elements of every business transaction, and their relationship is expressed in the form of accounting equation which always remains equal. At any point of time, there can be a change in the individual assets, liability or capital, but the two sides of the accounting remains equal. Combinations of the equation. The interrelationship between assets, liabilities, and capital can be expressed in various forms. Journalizing transactions. Transactions are analyzed into debit and credit parts before information is recorded. A form for recording transactions in chronological order is called recording transactions in a journal is called journalizing. Transactions could be recorded in the accounting equation. However, Most companies wish to create a more permanent record by recording transactions in a journal. The word journal comes from the Latin diurnal is, meaning daily. Most businesses conduct transactions every day. To keep from getting overloaded, the businesses will make entries in their accounting journals every day. In order to journalize a transaction, you need to have the source document for that entry or a listing of transactions. Source document abbreviations are as follows: check C, memorandum M, receipt R, invoice I. There are certain columns to be kept in mind: date of transaction, title of account, source document type and number, posting reference, amount to be debited, amount to be credited. Classification of accounts. An account is the basic building block of the accounting system of an organization. A separate account is maintained for each asset, liability, owner's capital, revenue and expense item. It is used to record increase and decrease in these items resulting from financial transactions. The financial transactions can be classified into three categories: transactions related to individuals, transactions related to property and assets, transaction related to income and expense. These transactions need to be recorded to determine whether the amount is credited or debited. A transaction record of an individual or an organization is called account. For each of the assets, liabilities, owners, capital, revenue and expense items, a separate account is prepared. The description of different types of accounts as shown in figure 3.2 is as follows. Personal accounts refers to the account of an organization or an individual. Personal account can be of the following types. Natural account refers to accounts that record transactions related to an individual person. Examples of natural account are Rahul's account and Kavita's account. Artificial account refers to accounts that record transactions related to entities such as company, institution, bank and firm. Representative account refers to accounts that represent a certain person or a group of persons. Impersonal account represents the accounts that are not related to the personal accounts. In other words, impersonal accounts do not relate to any individual or any physical entity. They can be further classified as follows. Real account refers to accounts that records transactions related to a property or an asset such as furniture, land or house. Real accounts are also classified into two accounts. Tangible account refers to accounts related to assets having a physical existence that can be touched, seen, measured, purchased and sold. Intangible account refers to accounts related to assets that cannot be perceived by senses but measured in terms of value, such as goodwill, patents, trademarks and copyrights. Nominal account refers to the accounts that record transactions related to expenses, losses, profits and revenues. These accounts are closed at the end of an accounting period. For example, purchase account, sales account, salary account, rent account, commission account and discount account. Double entry system. Under this system of accounting, every transaction in business involves at least two accounts. That is why the system of accounting is called the double entry system. Under this system, every transaction has two aspects, debit aspect and credit aspect. Under this system, every transaction is entered into at least two accounts in the ledger. In one account, the transaction is entered on the left hand side, that is on the debit side of the account, and on the other account, an entry for equal amount is made on the right side of the account, that is the credit side of the account. Double entry system is complete and scientific system. It is simple and efficient. Each business transaction affects the accounting elements in at least two ways, that is debit and credit. And this process of recording transaction is called double entry system. For each transaction, the basic accounting equation, assets is equal to liabilities plus owner's equity is affected. Significance of double entry bookkeeping system. The double entry bookkeeping system forms the basis of GAAP. It makes two entries for one transaction and is a very significant method of recording financial transactions in an efficient manner. This system is of practical importance as it helps in detecting errors in the accounting system. In addition, it allows the stakeholders and other users to receive an accurate financial report, the status of the financial performance, and the position of the organization. Rules for debit and credit. The debit and credit are the most fundamental concepts of accounting, which represent two sides of each individual transaction recorded in the books of account. As explained earlier, every transaction has two aspects, the aspect of receiving and giving. The aspect of receiving is also known as the debit aspect, while the aspect of giving is known as the credit aspect. Let us now learn how the rules of debit and credit are used in these different types of accounts, which is described as follows. In case of personal accounts, a debit in the personal account implies that the person whose account is debited becomes a debtor. Thus, when goods are sold on credit to a customer, then he or she becomes the debtor of the business. The debtor is the receiver and the creditor is the giver. In case of real accounts, a debit in the real account implies that an asset is purchased. Any further debit in the real account means more acquisition of the asset, and this would increase the value of asset. Any credit in the real account implies that some part or whole of the asset is sold off, and this would reduce the value of the asset. Here, the debtor is what comes in and creditor is what goes out. In case of nominal account, a debit in a nominal account implies that either an expenditure has been incurred, some loss has taken place, or some income has diminished by the amount of the debit. Credit in a nominal account signifies that income or profit is earned. The debtor is all expenses and losses, and creditor is all income and gains. Journal entry. A journal is a primary book of accounts in which all transactions of a business are recorded in the form of entries. You can also define the journal as a chronological in order of date record of then transactions of a business. The process of recording a transaction in a journal is known as journalizing. Date records the date when a transaction is made. Particulars records the names of the debit and credit accounts affected by a transaction. The debit account is written at the left side of the particulars column, DR is written at the right side, and the credit account is written in the next line with a prefix to. Narration is a brief description of the transaction. Ledger folio LF records the page number of the ledger on which the debit and credit accounts are posted. Debit amount records the debited amount. Credit amount records the credited amount. Steps in journalizing. The following steps are performed. Ascertain the accounts are affected by the transaction. Ascertain the nature of the account which is affected. Ascertain the account to be debited and the account to be credited by applying the rules of debit and credit. Ascertain the amount by which the accounts are to be debited and credited. Record the date and month of the transaction in the date column and the year at the top. Record in the particular column the name of the account to be debited, Along with the name of the account, the abbreviation DR also should be written in the same line against the name of the account. Write the amount to be debited in the debit amount column. Record in the particular column the name of the account to be credited. The name of the account to be credited should be written in the next line preceded by the word to. The word to is written towards the right after leaving few spaces. Write the amount to be credited in the credit amount column. Record a brief description of the transaction starting from the next line in the particulars column. This brief description of the transaction is termed as narration. Draw a line across the particulars column to separate one journal entry from the other. Compound journal entry refers to two or more transactions of the same nature that occur on the same date. Such transactions are recorded in one journal entry instead of having a separate entry for each transaction. For example, recording two or more accounts to be debited and one account to be credited. For example, on 28th March 2010, INR 5,000 is paid for rent and INR 3,500 is paid for freight. Ledger books. Ledger is a book or register in which transactions are permanently recorded, summarized and classified. A journal is organized as a chronological record of transactions. A ledger is organized by account. The ledger accounts are arranged under particular headings and help in preparing trial balance, after which the final statement is prepared. A ledger is also known as principal book. In a ledger, each account is divided into two sides, the debit side and the credit side. The left side of the ledger is called the debit side, whereas the right side of the ledger is called the credit side. Each side is further divided into 4 columns. The following is a brief description of these columns. Date records the date on which a transaction is made. Particulars records the names of the accounts to be credited on the debit side and the accounts debited on the credit side. Journal folio JF records the page number of the journal on which the posting of the ledger plays. Amount records the amount of each transaction. Difference between journal and ledger. The journal and the ledger are the most important books of the double entry bookkeeping system of accounting and are indispensable for a proper system. These books are closely related to each other. Journal. A journal is a book of first entry. It is a book for chronological records. It is a book of source entry and carries more weight as legal evidence than the ledger. The unit of classification of data in journal book is the transaction. The process of recording is called journalizing. Ledger. It is a book of second entry. It is a book for analytical records. It is a book that follows journal entry. The unit of classification of data in ledger books is the account. The process of recording is called posting. Posting in the ledger. Posting refers to the method of transferring the details of a transaction from a journal to a ledger. Transactions are posted to a ledger periodically, such as weekly or monthly, according to convenience. Perform the following steps to post the transactions of a journal to a ledger. Create the ledger accounts. These accounts are based on the accounts recorded in the corresponding journal. Enter the date of a transaction in the date column. Post the debited transaction of the journal entry to the credit side of the account, which is credited in the journal entry. Similarly, post the credited transaction of the journal entry to the debit side of the account, which is debited in the journal entry. Begin the debit side with to and the credit side with by. enter the page number of the journal from where the transaction is transferred to the ledger in the JF column. Balancing the ledger. Balancing an account means totaling the amount of both sides, that is the credit side and the debit side of the account, and writing the difference to the side whose total is less. Perform the following steps to balance an account. Calculate the amount of both the debit and credit sides of the account separately. Calculate the difference of both sides. If there is no difference, it means that the balance is nil. If the total of the debit side is greater than the total of the credit side, the difference is written on the credit side. And if the total of the credit side is greater than the total of the debit side, the difference is written on the debit side. Type the balance as to balance C/D if the difference is on the debit side. The word C/D means carry down to the next period. Similarly, type the balance as to balance B/D if the difference is on the credit side. The word B/D means brought down from an earlier period. A period refers to any duration, such as a month or 3 months quarterly according to convenience. Calculate the credit and debit totals at their respective sides of the accounts. Subsidiary books. A large number of business transactions take place, which makes it difficult to record all the transactions in one prime book. For convenience, a separate book is maintained for similar type of transactions, such as one book for receipts and payments of cash and another one for sale of goods and their purchases. A journal can be divided into a number of subsidiary books, which are: cash books, includes the records of all the receipts and payments made by cash and checks. The cash book, which is used to record cash as well as bank transactions, is known as bank book. The cash book has two sides, namely the left side, which records all the cash receipts, and the right side records all the cash payments. The special feature of the cash book is that it functions as a journal and a ledger with regard to the cash and bank transactions respectively. Purchase book involves the records of the credit purchases of goods. However, the cash purchases of goods or the credit purchases of assets are not recorded in this book. Purchase return book includes the records of the return of goods and materials sent back to the suppliers. It is also called return outward book. Sales book involves the records of all the credit sales of goods. However, it does not record the cash sales of goods or credit sales of assets. It is also known as sales journal. Sales returns book includes the records of the returns of the credit sales received back from the customers. It is also known as the return inwards book. Bills payable book involves the records of all the issues of promissory notes or bills of exchange accepted by the business regarding the amount owed to the suppliers. Journal proper constitutes the records of the transactions which cannot be recorded in other subsidiary books. It usually records the transactions that are of infrequent nature, such as adjustment entries, opening and closing entries, and interest on capital. Now, in the end, let us summarize what we have learnt in the lecture. Summary. An account is the basic building block of the accounting system of an organization. A separate account is maintained for each asset, liability, owner's capital, revenue, and expense item. Transactions are analyzed into debit and credit parts before information is recorded. A form for recording transactions in chronological order is called recording transactions in a journal is called journalizing. The financial accounting cycle is the process of recording business transactions and processing accounting data to generate useful financial information. The financial accounting process consists of categorizing past transactions and events, measuring selected attributes of those transactions and events, and recording and summarizing those measurements. A number of subsidiary books are opened for recording all business transactions in a systematic manner.